Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, August 12th, 2025, has been, well, it's been a whirlwind.
It really has. Lots of moving pieces.
Exactly. So our mission today is to cut through all that noise, find the really important stuff, the surprising connections across tech, the economy, even some global headlines you might have missed. We're going to try and make sense of it for you.
And I think what's crucial, really, is looking beyond just the individual stories. You start to see how seemingly separate things actually connect. You see these bigger trends, these underlying currents shaping things.
Yeah, how old rules are maybe getting bent or broken.
Precisely. That's what we need to explore.
Okay, let's dive in. The tech sector first, because AI is just, it's moving incredibly fast.
Lightning speed feels like an understatement sometimes.
Right. So first up, Perplexity. They're what, a nearly 3-year-old AI search startup?
Yeah, relatively new on the scene still.
And they've made an unsolicited offer for Google's Chrome browser, $34.5 billion.
Okay, wow. That number itself, it makes you stop. I mean, $34 billion for a company valued at, what was it, $18 billion recently?
Exactly. Nearly double their own valuation. Against Google's like $2.5 trillion.
So is this a serious bid, or is it more like a strategic play? Maybe putting pressure on Google or, signaling Perplexity's own value.
That's a really sharp point. And Wedbush's tech analyst, Dan Ives, he actually called it a smart and opportunistic move. And the timing is key, isn't it?
Absolutely. It ties directly into Google's legal troubles.
Yeah, that landmark antitrust ruling last year. The Justice Department literally suggested Google sell Chrome as a remedy.
Which Google is fighting, obviously. They called the idea unprecedented, harmful.
Of course. But Perplexity is jumping right into that vulnerability. They're positioning themselves as the Google search challenger, talking about upending how we find info online, championing the open web in the AI age.
And then launched their own browser, Comet, didn't they?
Last month. They did, pitched as more personalized. The offer itself has details, too. They say they'd keep Google as the default search, commit to 100 months of Chrome support.
And invest $3 billion in Chromium, Google's open source tech.
Yeah.
That's not insignificant.
No, it's serious money. But Ives still pegs Chrome's value higher, maybe $50 billion plus. He called it a game of high-stakes poker.
High stakes indeed. And it's not Perplexity's first big gamble, right?
Mm-hmm.
Didn't they bid for TikTok?
They did, earlier this year, after that law requiring ByteDance to sell. And get this, Meta and Apple have reportedly had talks about buying Perplexity themselves.
Whoa, okay.
And OpenAI is apparently building a browser too, so everyone wants a piece of that web interaction space.
What's really fascinating here, though, is the shift in focus. It suggests maybe controlling the browser is the new strategic high ground in the AI era, even more than search itself.
Like the interface is the key.
Exactly. If your browser is your AI, Google's search dominance looks, well, potentially less secure long-term, even without directly competing on search results alone.
Okay, and speaking of fierce competition and legal threats, Elon Musk, he's back in the headlines.
Is he ever really out of them?
Good point. This time, he's taking on Apple. His AI startup, xAI, is threatening to sue Apple over App Store rankings.
Alleging what? Favoritism.
Yeah, alleging they favor OpenAI's ChatGPT, calling it an unequivocal antitrust violation.
Okay, so beyond the usual Musk drama, what does this tell us about the power dynamics, platforms versus the apps, especially with AI?
That seems to be the core issue. Access, visibility on these dominant platforms is becoming a real battleground, isn't it? Especially if the platform owner, Apple, has its own AI partnerships.
Like the one with OpenAI.
Exactly. Musk went on X, naturally, claimed Apple makes it impossible for any AI company besides OpenAI to reach #1. Grok, his AI, is apparently #6. ChatGPT is #1.
Did he provide any proof?
Nope. Sources say neither Musk nor Grok offered evidence. He also complained X isn't in Apple's must-have section, implying politics. Remember, Apple partnered with OpenAI back in June 24.
Right, and Musk threatened to ban Apple devices at his company's end.
He did. And Apple's no stranger to antitrust scrutiny either. That Epic Games lawsuit ruling in April, the big EU fine.
True. This isn't their first rodeo with App Store rules.
Plus, this is another chapter in the Musk versus Sam Altman saga, right? After Musk sued OpenAI last year over its mission.
And Altman fired back, suggesting Musk games the algorithm on X for his own companies. It's messy.
Very. And we should probably mention Grok itself has faced criticism.
Huh?
Safety issues, manipulation, promoting false claims, even some really disturbing stuff in past responses.
Yeah, that context is important too. It's not just a straightforward business dispute.
Definitely not. Okay, so shifting from corporate battles to geopolitics, but still sticking with AI. The US government, China, and computer chips.
Ah, yes, the Nvidia and AMD deal. This one really raises eyebrows.
It does. So, Nvidia and AMD have agreed to pay the US government 15% of their revenue from selling certain semiconductors to China.
In exchange for export licenses, which the previous administration had blocked.
Right. Citing national security for chips like Nvidia's H20 and AMD's MI380. This deal lets sales restart, but with this 15% cut going straight to the US Treasury.
And the structure is unique, to say the least. It's not a tax, because the Constitution forbids export taxes. It's a voluntary agreement.
Which sounds a bit unusual. Legal experts are apparently struggling to find any precedent. Some even say it might be illegal.
And the companies get no say in how that money is spent. So what's the government's thinking here?
The White House line is it maintains U.S. AI dominance while getting a trade deal. This sort of implicit argument seems to be China will get advanced AI chips one way or another, maybe black market.
So better for U.S. companies to sell legitimate, controlled ones, and the U.S. government gets a cut.
Seems to be the logic. And financially, it's potentially huge. China was 13% of NVIDIA's sales in 2024. Even with the 15% cut, analysts think this could bring in billions for NVIDIA and maybe $5 billion a year for the White House.
But there's disagreement about the chips themselves, isn't there? Trump called the H20 obsolete.
He did. But experts push back, saying they're still state-of-the-art, especially for inference. You know, running AI models, answering questions, even if not top tier for training like the H100s or Blackwells.
And China's reaction?
Yeah.
A bit wary.
Yeah, a state-linked social media account warned they might not be safe, mentioned backdoors, which NVIDIA denies, could be posturing, maybe trying to boost their own domestic chip makers.
This whole deal, though.
Yeah.
Some are calling it shakedown capitalism. The executive branch leveraging power to get payments from private firms outside the usual tax system. It raises fundamental questions.
About the balance of power. Free markets. Yeah, big questions. Okay, let's broaden the lens now to the economy. It's complicated. Good news, bad news, lots of debate.
Definitely. And the numbers themselves are becoming part of the political fight.
Let's start with inflation and those tariffs. The July CPI numbers are out.
Right. Headline inflation looks relatively tame, actually. Up 0.2% for the month, seasonally adjusted. Annual rate holding at 2.7%. Falling gas prices help there.
Okay, but what about core inflation, excluding food and energy?
That's where it gets interesting. Core CPI rose 0.3% in July, fastest since January. And it's up 3.1% from a year ago, highest in 5 months.
And economists are saying the tariffs, Trump's tariffs, are showing up in those numbers.
Some definitely are. They point to categories exposed to tariffs. Household furnishings up 0.7% monthly. Footwear jumped 1.4%, highest in years. Windows, floor coverings up 1.2%.
So things people actually buy.
Exactly. Mark Zandi, Michael Pierce, they see core commodities rising 0.2% for 2 months straight as clear evidence of tariff impact.
And who's paying for these tariffs? Is it foreign exporters, U.S. businesses, or us?
Well, according to a Goldman Sachs report, initially, foreign exporters absorbed only about 14%. U.S. businesses ate about 64%. But that's projected to shift.
How so?
They expect businesses' share to fall to just 8% over time, while consumers, who absorbed 22% through June, could end up bearing up to 67% of the cost by October.
Wow. So the burden shifts heavily onto consumers, and yet the budget deficit grew in July, even with tariff money coming in.
Yeah, the deficit was up nearly 20% to $291 billion. Outlays, government spending, just grew faster than receipts, even though customs duties from tariffs hit almost $28 billion that month.
It's complex. And not everyone agrees tariffs are inflationary, right? Art Laffer, the Reagan advisor, argues they actually decrease prices historically.
It's a contentious point, definitely. Different economic schools of thought.
Okay, so with this inflation picture, what about the Federal Reserve? Any rate cut expectations?
Well, Rick Reeder at BlackRock, he's a big voice.
Mm-hmm.
He's sticking to his call for a half-point cut in September, a jumbo cut.
Based on what?
He sees the latest inflation data as showing less than expected price pressures overall, plus that dramatic slowdown in the July jobs report.
But Fed Chair Powell, he linked rate cuts, or the lack thereof, to the tariffs, didn't he?
He did. Testified back in July that the Fed would have cut rates already this year if the administration hadn't implemented its major tariff policy.
And President Trump is keeping the pressure on Powell.
Oh, yeah. Reportedly considering a lawsuit against Powell over Fed building renovations, calling his management horrible and grossly incompetent, and publicly demanding he now lower the rate.
And threatening to name a successor early, Powell's term isn't even up until May.
Correct. It ramps up the political pressure immensely. Which brings us back to that question about Fed independence, doesn't it? If decisions seem driven by politics, not data.
It undermines trust. And speaking of data integrity, the Bureau of Labor Statistics, the BLS, the source of all these numbers,
Is under incredible scrutiny right now. Major upheaval.
President Trump fired the commissioner, Erica McIntarfer, earlier this month, baselessly accused her of rigging jobs data after that July report came in lower than expected, with big downward revisions for May and June.
And he nominated E.J. Antoni from the Heritage Foundation to replace her.
Yes. Antoni is a known, outspoken critic of the BLS. He called McIntarfer incompetent, agreed Trump should appoint a MAGA Republican loyalist.
And he's criticized BLS methodology before, right? Questioned the data collection, the revisions, even called a past CPI change an Orwellian trick.
He has. He noted revisions have gotten significantly larger since the pandemic, like finding 589,000 fewer jobs created in 2024 than first reported. He even suggested suspending the monthly jobs report entirely at one point, though the White House now says reports will continue.
So what's the reaction from other economists?
Strong backlash. Jason Furman, Justin Wolfers, many others calling Antoni completely unqualified, disastrously terrible, huge worries about losing the BLS's credibility as a nonpartisan agency.
And the BLS itself is facing challenges. Budget cuts.
Yeah, they warned that budget and staffing cuts from the Department of Government Efficiency are disrupting data collection, which could make the data even more volatile and prone to revisions.
It's a critical situation. If you can't trust the fundamental economic data, how do policymakers, businesses, or even just regular people make sound decisions? It erodes the foundation.
Absolutely. It forces you to question everything. Okay, let's shift away from the big economic policy debates and look at some specific industry shifts and some pretty unexpected events.
Right. The stuff happening on the ground.
First, some struggles. Spirit Airlines. They just got out of bankruptcy in March, right?
Yeah. Wasn't that long ago.
Now they're warning there's substantial doubt they can stay in business again.
Wow. What's going wrong?
They're citing weak domestic demand, a tough pricing environment, cash reserves dwindling. They're furloughing pilots, demoting others, need to sell assets. Even their credit card processor wants more collateral.
It really shows how brutal the airline industry can be, even post-restructuring, and how quickly things can turn.
And it's not just airlines. Kodak, remember them?
The photography giant. Filed for bankruptcy years ago, 2012.
Well, they just filed an SEC notice saying there's substantial doubt about their ability to continue again.
No kidding. After all this time, what happened?
Plans to pay off debt with pension money and refinance are apparently deemed unreliable under accounting rules. And the root cause is still the same old story, isn't it? They invented digital photography in '75.
But we're afraid to embrace it because it would hurt their film business.
Exactly. A classic case of failing to adapt. It's fascinating how these legacy companies just keep facing these existential threats.
It's a tough lesson in how critical adaptation is and how long the consequences of not adapting can last.
But, okay, it's not all bad news. Some companies are getting creative, finding ways to thrive, like Applebee's and IHOP.
The Dine Brands combo, what are they doing?
They're expanding that dual-branded restaurant model nationwide, one building, Applebee's on one side, IHOP on the other, often sharing a kitchen.
To capture different times a day.
Yeah.
Breakfast and dinner drinks.
Precisely. All day parts. Single kitchen, cross-trained staff, streamlined menu with top sellers. And franchisees are apparently making 2 to 3 times more money than with a single IHOP. About 40 cents of every extra dollar is pure profit.
That's impressive. Combining strengths, cutting costs, smart.
They tested it overseas first, then a successful U.S. test. Now rolling it out.
It really shows how companies are thinking outside their traditional boxes, isn't it? Combining brands, looking for new revenue streams.
Like Taco Bell, they're launching Baja Midnight. First permanent new Baja Blast flavor in 20 years.
Just a new drink flavor? Or is there more to it?
It's part of a bigger push. They want to grow beverage sales to $5 billion within 5 years, targeting Gen Z with new drinks, expanding those live Moss cafes.
Ah, the cafes. Have those been working?
Apparently phenomenal success. One in San Diego saw a 40% sales boost. So drinks are a serious focus.
Interesting. And Cava. the Mediterranean chain.
They lowered their sales forecast after Q2 same-store sales growth wasn't quite as high as expected, though still better than much of the industry. But here's the interesting bit. They invested in Hyphen.
A restaurant automation startup.
Yeah, to boost order accuracy and speed, especially for digital orders during peak times, betting on tech to improve efficiency.
Makes sense. Automation is a huge trend in food service.
And one more bright spot, the Las Vegas Sphere. It's really taking off.
With that Wizard of Oz thing.
Yeah, sold over 120,000 tickets already, aiming for 200,000 by the first show. They're using AI outpainting to expand the movie frames for that massive screen, plus crazy sound, 4D effects.
But creating a whole new kind of immersive experience.
Exactly. And they expect it to boost the percentage of Vegas visitors who actually go to the Sphere from 7% to over 10%. So it's drawing people in.
These are all examples of innovation, really, finding new ways to engage customers or streamline operations in a tough environment.
Right. But then sometimes the environment throws a wrench in the works in ways you just don't expect, like jellyfish.
Jellyfish?
Yeah. 4 reactors at Francis Graham Line's nuclear power plant had to shut down. Why? A massive and unpredictable swarm of jellyfish clogged the cooling water intakes.
You're kidding. Jellyfish shut down a nuclear plant.
It's apparently.
Right.
Likely linked to rising North Sea temperatures, global warming accelerating breeding cycles, and maybe invasive species hitching rides on ships.
Wow. That just highlights how interconnected everything is, doesn't it?
Mm.
Climate change impacts infrastructure in totally unforeseen ways.
And it points out that even nuclear power, often called clean, has side effects like heat pollution affecting ecosystems.
It's a stark reminder of vulnerability. Even our most advanced tech isn't immune to nature.
Totally. And speaking of tech giants moving into unexpected areas, Tesla. While their car sales were down in Q2,
Revenue dipped. Yeah.
they've applied for a license to supply electricity directly to homes in the UK.
Expanding their energy business then. They already do that in Texas, right?
Yep. And their energy revenue almost doubled last year. It fits Musk's goal of accelerating the transition to sustainable energy, trying to simplify the whole retail electricity experience for consumers.
So a tech company becoming an energy utility, another example of blurring industry lines.
Definitely. Okay, let's shift one last time to some financial trends hitting closer to home for many people. How you pay, how you save for college.
Yeah, the everyday money stuff.
Let's talk about buy now, pay later, BNPL. It's everywhere now, isn't it?
It really is. Klarna, Affirm, Afterpay. Now even Walmart, Apple, Amazon offer it.
So just to be clear for everyone, it's short-term financing, right? Pay in installments, often interest-free for those pay-in-4 plans.
Exactly. Pay maybe 25% up front, then 3 more payments over, say, 6 weeks. Often just a soft credit check, so it's appealing if you have bad credit or no credit history.
And it's popular. Nearly half of Americans have used it. And almost a quarter have had 3 or more loans at once.
The numbers are huge. Expected 91.5 million users in the U.S. this year.
The pros seem obvious. Smaller payments, quick approval, no need for a perfect credit score. But the cons.
Well, the big one is it can encourage reckless spending. Over 40% of users admit they've paid late. That can trigger late fees, often $10 or more.
And returns can be tricky. Getting refunds when you've only paid part of it.
Yeah, that could get complicated. And the big question, does it hurt your credit score?
Right. What's the latest on that?
FICO is starting to include BNPL data this fall. But it's messy. Some providers like Klarna and Afterpay say they won't report to bureaus, while Affirm does. So it's inconsistent.
Something to watch out for. Okay, staying with personal finance college costs, we keep hearing about sticker prices hitting $100,000 a year.
It's staggering. The headlines are scary.
But the reality is different for most families, isn't it?
Absolutely. Very few pay that full sticker price. The average amount families actually spent in 2024-25 was closer to $31,000.
Ow. Financial aid mostly.
Yes. Scholarships and grants cover over a quarter of the costs on average. Student loans cover a lot of the rest, of course. But aid is key.
So finding schools that are generous with aid is crucial. The Princeton Review list, for example.
Right. They rank schools on aid generosity and student satisfaction. Look at Princeton University itself. Sticker price around $86,000.
Oh.
But their average need-based scholarship is over $73,000, bringing the average out-of-pocket cost down to under $13,000. And many schools on that list meet 100% of demonstrated need for first years.
So the message is, don't let the sticker price scare you off completely. Do your research on financial aid.
Definitely. It highlights this contrast. New payment methods like BNPL offer flexibility but need careful management, while higher education, despite scary headlines, can still be accessible if you navigate the aid system well.
Okay, we've covered a lot of ground. AI power plays, economic tug-of-wars, companies pivoting, jellyfish attacks.
It's been quite a day.
It really paints a picture of a world just constantly shifting, doesn't it? Where the old rules feel like they're being rewritten on the fly.
I think if you connect all these dots, the big takeaway is about adaptation and, maybe more importantly, critical evaluation. What assumptions that felt stable just yesterday are now being challenged?
Like the stability of economic data or the separation between government and corporate finance.
Exactly. Or even our vulnerability to environmental changes we didn't fully anticipate. Are we really prepared for a future where economic stats are political footballs, where corporate power and government deals get really intertwined in new ways, and where nature just throws these curveballs?
Big questions. And for you, our listener, that's where the real deep dive starts now, right? What part of this conversation stuck with you? What new question did it spark?
Because just knowing the facts isn't enough anymore.
No, it's about understanding how they connect, what they might signal for tomorrow. We hope this deep dive gave you plenty to think about and maybe some threads to pull on your own.